am also a tax strategist, and I've been in the finance industry for over 18 years. As a solopreneur, right, or someone who's an entrepreneur. Hello, Five Finance family. Welcome to another edition of the Tax Takeover. I'm super excited about tonight's show because we have an expert who is going to be walking us through investment planning. Okay, so this is investment planning 101. So I want to make sure that you stay engaged throughout the show. Get out your pens and your pads because you're going to want to take notes because there's going to be a lot of good content, good information that's going to be shared in this conversation tonight. All right. So if you are joining for the first time, I am your host, Samara Andrews. I am an enrolled agent with the Internal Revenue Service. And what that means is that we have a deep understanding of the tax code and we use that understanding, that knowledge to leverage the tax code for the benefit of our clients. That's what the tax takeover is all about. We bring before you tax strategies and tips week after week so that you can be informed, right? And start your journey of tax planning. We have a motto here, right? That the wealthy don't start tax planning once they become wealthy, but rather use tax planning as a tool to grow and protect their wealth. So that's what the tax takeover is all about. So continue to join us week over week, right? If that is what you want to do, you want to earn, make more money, protect your wealth, definitely tune in week after week, right? So without further ado, I want to make sure that I introduce our guest, y'all. I'm super excited. Dr. Noni Carter. Oh, I almost messed up her name. Dr. Noni Carter so graciously said that she would come tonight and share with us investment one-on-one, like what investment planning is, how it looks like. Definitely going to equip us with some tools to get us on the right path. And please stay until the end because she's going to be sharing some a bonus information, right? For those who want to connect with her, she's going to be sharing a little gift to all of the Five Finance audience. So make sure that you stay until the very end. So without further ado, let's bring on Dr. Noni Carter. Hello, Dr. Carter.
Hi, Samara.
How are you?
I'm excited to be here today with you. Thank you for the invitation.
Absolutely. Thank you so for accepting the invitation, right? And so graciously appearing on the show and sharing with the Five Finance family. So if you can please introduce yourself, that would be great.
Absolutely. So, Dr. Noni Carter, I am a financial advisor with Edward Jones. And what I like to say about my branch is that we believe deeply in the importance of understanding the stories around what matters most to our clients, their families, and of course, for this audience, their businesses, right? Which is at the core of what I do in my branch. We work a lot with business owners in the city and across the country. We develop tailored, quality, comprehensive, and forward thinking strategies to help our clients reach their ever evolving goals with the goal of partnering with them for the long term. So I'm really excited to sort of share with you today what that looks like and get into the weeds of investing and comprehensive planning overall.
Okay, so you're already speaking my language, right? Partnership, getting into the weeds. That's what accountants do, right? And Five Finance, we say the same thing. We partner with our clients to help them achieve their goals. Okay. Also, I love it already. All right. This is good energy, y'all, Five Finance family. So definitely lean in. You're going to want to pay attention. So, to kick things off, could you explain to us the fundamental importance of investment planning in building long term wealth? And especially for individuals who are concerned with their taxes and their financial stability.
So, a lot in your question there that I'd like
Right.
to sort of maybe break down into different
Please.
parts. One, I want to start with this title that you have, Investment Planning 101, right? So, a lot of times when people think business owners, individuals, families, think about investing or finding a financial advisor to help them through the process, the first thing that comes to mind is how can I grow my money? How can I grow my assets in the stock market, right? And what I want to emphasize here is that's when it comes to financial advising, it's an old school mentality of let me take your money and throw it in the market, and that's all we're doing. there is so much more that I do with my clients that falls under the category of comprehensive planning. That's what we like to think of
Mm,
more so than investing, right? Comprehensive planning, of which investing is just one small piece, right? So putting money in the market requires planning strategies that are preliminary to, supplementary to, and then even serve as a follow up to investing, right? So today I wanted to sort of discuss financial wellness
mm,
as a holistic process rather than just an investing process. And we can sort of talk about what that looks like and what that means. When clients come into our office, we have an Edward Jones established process. We call it our 5 question wheel. We
mm.
start with the question, where are you today? Right. And so we consider ourselves as giving goals based advice rather than just investing advice. So
Love
we
it.
start with the question, where are you today? We do a deep dive into your various goals. Oftentimes, clients come to us saying, oh, this is what I want to do. But we talk for 45 minutes and understand that there's something deeper underlying that particular goal. That's our job, right? Is to figure out what that looks like. So then we can then find the vehicles, the investment vehicles, the accounts that are appropriate, the tax strategies, right? Associated with those goals. Number two, where would you like to be? Right? We call ourselves, we think of ourselves as long term investors, long term planners. So, where would you like to be? Three, can you get there? Four, my favorite question, how do you get there? And we'll talk about that today. And number five is just staying on track, partnering for the long term, right? Maintaining momentum, being able to adjust when necessary, when the unexpected arises, being present when life takes a turn, whether that's for the good, or something drastic happens that we sort of step in and need to alter your investment strategy. So I just want to emphasize investing is important. Comprehensive planning, right, is the bubble around that matters when we're thinking about our long-term strategies. In terms of wealth transfer, this is really
Mm.
a historical time. You hear this on the news where wealth is being transferred in such a way that it never really has. So this is a significant time to sit down with your families, make sure that you have that financial advisor to discuss the most appropriate ways to think about passing wealth on, whether you're inheriting, whether you want to give money to children through 529s and that sort of thing.
Okay, Five Family. You heard that 529s, y'all. I just had a show about a 529 plan and how beneficial it is. And we discussed some of the changes that are going to go into effect in 2024 concerning the 529 plan. Because I was just sharing with our audience that it used to be that big vehicle was used only for saving for colleges, but now they've put in a little strategy in that plan itself saying that, hey, if your child doesn't go to college, guess what? You can roll over some of those investments, right, into a retirement plan. And there are definitely some requirements that have to be met, and we outlined all of that for our Five Finance family. But I'm glad you mentioned it. Because it definitely is more than just investing in the stock market. And that definitely covers the next question I was going to ask, because I was going to ask what are some of the common mistakes and misconceptions people have around investment planning?
Okay. So one of the biggest is sort of what I just outlined here is that,
Right.
you have a bucket of money. You approach that money without necessarily breaking down the goals first, especially for business owners who need to first sort of segregate personal finances from business
Mm,
finances. And you think to yourself, well, I've gone too long without investing. Let me just dump this in the market. Let me fill out that risk tolerance questionnaire and say that I'm an aggressive investor because I'm in my 30s and call it a day. Right. And that sort of works contradictory to the process that we go
right.
through, which is why, and I'll talk about this. I have a process that I want to share called my 3 milestones to financial stability.
Okay.
There's 3 milestones for personal investing and personal finances, and then 3 milestones for businesses, right? But to sort of skip the steps, skip to step number 3 without understanding the foundation leads to situations where I get clients coming in who are pulling from their 401ks before they're 59 and a half, right? Who are pulling from their Roth accounts, paying these penalties to the IRS simply because there wasn't a plan in place, right?
Mm.
So a misconception is that we can invest without that plan. And I think, especially in our community, to start building habits around better wealth management means to start to sit down and start and begin evaluating the comprehensive piece. What are all of the different aspects? And I don't know if you have a question for me with the milestones, but
Yes,
I'd
I
love
do.
okay.
Yeah, so if you don't mind, can you please break down those three milestones for personal and for business owners?
Absolutely. So there are a lot of pieces to it. So stop me when you need to. We can talk about something and then I can jump back in
Okay.
because this is really, this is the foundation. This is really where we begin. I don't care if you walk, into my office with $40,000 to invest, $10,000 to invest, or if you're making $750,000 a year and you're trying to find, investment vehicles that can help you save more for retirement. This is sort of the process for everyone. So let's start with personal, okay?
Yes,
Because I know business owners, you have to deal with your personal finances, right?
that's right.
That's significant, and oftentimes you're commingling. And the part of the process we want you to get to you to sort of separate and have a different plan for the different buckets. So milestone one is about building a foundation. Again, it looks different for high net individuals versus not so high net individuals. The first step here is growing and developing a reserves and emergency savings bucket. Again, I give that example of clients who come in and they're pulling from 401ks, taking loans out simply because they were never told to prioritize putting aside a bucket of money that you can draw from if need be, right? And that need be might be your business isn't doing so great. Maybe you lost a job for 3 to 4 months, right? Or maybe a health issue arises and you need cash. We're moving into a moment right now where our COVID cash that we put aside and saved so diligently is almost gone, right? So to emphasize and prioritize and start here, growing that emergency and savings bucket is super important. I think of emergency as separate from reserves. Reserves is that 3 to 4 months, three to
Okay.
6 months of expenses that you sort of set aside and you grow gradually. Maybe you start with $100 a month, right? Just to get to that goal. Emergency money is that bucket, maybe 2 to 5K that you set aside if, the window of your home breaks or if the car breaks down and you need to pinch a couple of thousand to sort of deal with that, right? So first step in building a foundation, getting that reserves built up. Second step is making sure that you're conscious of and addressing and paying down what I call high interest, non deductible debt. High interest, non deductible debt. So I think of high interest as any interest rate on your loans, on your credit cards that is greater than what the market is returning to you over time. So let's say you have money in the market, right? Let's say you have a traditional IRA and that IRA is growing over time, at an 8% rate.
Mhm.
Well, if you have debt that's greater than that 8%, it's sort of working,
Against.
it's contradictory to the money that you're earning in the market. You're losing what you're gaining. So we really encourage clients or create strategies around how to pay down high interest, non-deductible. You might think of credit cards in this instance. Mortgage payments are deductible
Mhm.
most times, right? But credit cards are non-deductible. You can't deduct them from your taxes, right? So thinking about paying down these high interest, non-deductible debt first. Number three would be to sort of focus on, and I know you've heard this again and again, but when you first start planning, the first couple of months, I say to my clients, is super intense because you really want to make sure that you're tracking your spending. You understand what sort of discretionary income you have, that extra cash that you have, that then we can start building a saving strategy around.
Right.
Oftentimes, clients aren't so sure how much they have to set aside each month. Getting clear on that helps us determine where to go next,
Mm.
right? And the last piece of milestone number one is, and you talk about this on your podcast in the past, but just having a basic estate plan in place. Oftentimes, people think that's not part of our job as financial advisors. That will often be the first question I ask you. Do you have a will? Do you have beneficiaries and TOD designations on your accounts?
Mhm.
And do you have things in place for incapacitation, like POA and
Right.
healthcare directives?
Right.
So that's milestone number one, building a foundation. Should I pause here or can I keep?
Yeah, because I do want to, because we have talked about approaching debt through like the debt avalanche. Have you heard of that concept? It's like attack, right? So it's
Yeah.
sort of like what you were talking about, right? attacking those interest rates that you
Mhm.
cannot deduct. And I'm glad that you brought up mortgage as an example because, yes, when you talk about your mortgage interest, that is something you can deduct on your Schedule A, okay, taxpayers, if you are able to itemize. All right. So that's what Dr. Noni is talking about when she was saying different interests that you cannot deduct. If for
Mhm.
my business owners, right, which she'll probably get into in the next section, it would be something like the interest that you are paying on your car if you're using that vehicle for business purposes, more than 50%, right? So if you're using that car for business purposes, then the interest, okay, can be deducted on that. So we're not talking about those interest rates. We're talking about more like your credit card. Can deduct that, right? So when you have those personal credit card bills, right, or those payday loans, hopefully I don't have those, but those type of things where you're paying that interest that you cannot write off on your tax return, those are the ones that you need to attack first because it is working against you. And I'm glad you threw out the 8%. I was because inflation has been like so up and down. I know when I was in school, that was like the market standard was like about 8% is what your return would be. And I didn't know if that was still the case. So it's about still 8% again.
Well, let me clarify that. I think, you talk to different advisors, they have different opinions.
Gotcha.
About 8% as a standard number, but, depending on who you work with, that number might be higher, right?
Gotcha.
Edward Jones has a more conservative approach. They might drop it down to 5 or 6%. So, I throw that out there not as your account should absolutely be growing at 8, but it's a standard number somewhere between 5 and 9,
Right.
and I tend to land on 8 with my clients. It's just what feels comfortable.
Good. And I'm glad you explained that as well. All right. So let's
Mhm.
move on to, yeah, let's talk to my business owners now.
Let's do business owners. Actually, I do want to add something to what you
Yeah.
said, which is really important. Talking about debt, credit, building good credit, especially if you're a business owner, right, is super important. And I want to add here that not all debt is bad debt, right? We talked about mortgage payments. Using debt to strategically build your credit is something that I don't think we talk about as often as we can. If you get a lump sum of money, you get $100,000, right? You inherit this money. Some of us might feel that the responsible thing is to just get rid of all the debt that you have.
Mm-hmm.
That's not necessarily the
Mm-mm.
first step that you want to take, which is why discussing options with a financial planner, right, is important here. So just keep that in mind. Sometimes you use debt strategically, and that's why you want to understand the difference between what's deductible, what's not deductible, what's high interest versus what's not high interest. So
Yep.
I just wanted to add
No, and I'm glad you said that because I remember I had a client and this was during the was it during the pandemic? I felt like it was during the pandemic. So she was trying to buy a home. Well, about a year or two ago, it was like cash is king, and you could not get a home fast enough if you were
that.
trying to go through the traditional process of getting a loan, getting to the table to close. Like people were just using their cash to buy up these homes because they were then flipping the homes and using them as an income producing property, right? And so she was like, "Oh my God, what do I do? Like, I have the cash, but," and I'm like, if it were me, like, I would try to use debt, good debt, to purchase this home and not dip into my retirement to purchase this home.
Just a home.
That
Yeah.
was the advice that I gave her. So I feel good now that I gave her some sound advice because I was just going off of like if I were in those shoes, right? Because you just don't know what the market is going to do. And if you like roll that dice and then you roll some craps, it is what it is. And I didn't want her to like dip into her retirement and then lose all of that money, right? And then she's just left with this property. So
Yeah.
thankfully, I told her right.
Yeah,
Because
and I'll add to that, like it's important to understand that strategies should be tailored to your circumstances because there might be that one piece of information, maybe you own land or maybe, that changes the strategy with you as
Mhm.
opposed to someone else. And so to understand that you don't want to hear something on the internet or read something and say automatically that works for me. You
That's
want to
right.
do a full comprehensive breakdown of what's going on in your household with your business, because then that can determine, because to your point, Samara, there are situations where yes, there is good debt, right?
Right.
In other cases, you might not, you might want to pull from the 401k.
Right.
It depends on your
Right.
circumstances. And
Right.
that's why you have your team. And that kind of goes into milestone number one for business owners,
Okay.
right? Building your foundation. One of the first steps you want to take is to build a quality team. And by team, I mean that you have Samara here as your accountant. You have your financial advisor that can look at pieces of this long-term strategy that you might
Right.
not be seeing. Then you have your attorney, right, that can point you in the direction of laws as they're changing. You want to make sure that you're building, meeting individuals and building that solid team so that you are saving in the right places, you're using tax advantage strategies, but you're also doing things in such a way that makes sense for what is unique to you and your business. So that would be the first piece of business owners building their foundation. The second, I said this, so I'm not going to linger on it, is segregating your funds. This is so important. Most of the business owners that come to me, they're small business owners, and it's just not segregated, right? And it's difficult to be able to outline your goals for the business when you're paying your Netflix on your business card, right? So just, and that's something that you can do alone. It's something you can do with a financial advisor, something you can do with an accountant, right? I know, Samara, you work with business owners in this
Yes.
capacity as well, which leads you to being able to understand, as Samara was saying earlier, what you can start to write off, the expenses that are deducted against your revenue. If you get clear about what funds are being used for your business, then you can start creating a solid strategy around your write offs. And then the third piece for building a foundation for businesses, I can't emphasize this enough, is to get a sense of your short and long term goals,
Mm.
not just your vision, but also financially, right? When I work with businesses and nonprofits, there's a list of questions that we sit down and go through. It often takes a while because sometimes business owners aren't quite sure. Do you want this business to be a cash cow? Are you planning on
Mm.
passing this on to children or community? What are your short and long term goals? Starting from there, that foundation will help us determine the right investment strategies, the right accounts that you need, right? But this is where to start. That's building a foundation for a business.
I absolutely love it because you are pretty much saying every single thing that I have shared in the past on the tax takeover. And I love the aspect of having that team, right? So here's the thing, Five Finance family. Me and Dr. Noni work together, and we can only work together for your benefit when you are disclosing everything. And so it's good to understand like who needs to be at the table, right? Because I tell people that when a client connects with me and we're going through a tax strategy, we're putting together a tailored plan for that client. Guess what I say? Here's what you need to do as far as retirement planning or investment planning, but I'm not the person that's going to do it for you. Like, I have Dr. Noni. You need to reach out to Dr. Noni, talk to her. She can help you get your account set up and talk in more detail about the benefits, right, of having this strategy in place. Same thing when you talk about the estate attorney, right? There may be times we have to pull in an estate attorney as well. And that estate attorney needs to be at the table. They absolutely need to understand all of your goals, short and long, right? So that we can put in strategies to help you achieve those goals. And there's definitely check ins that I do along the way with my clients, Dr. Noni. I'm sure you probably do it as well to just make sure that they're staying on target. But having the right people at the table, I cannot stress enough how important that is because that is ultimately going to be the determination on if you're successful in achieving your goals.
Absolutely. Absolutely. Like this, Samara understands this. We've had this conversation. This industry is about relationship building first.
Mm-hmm.
And relationship building goes in all different horizontal with building the professionals that I work with and in building the relationship with my clients. So checking in with them, but also making them understand that if, I know somewhat my taxes, right? I can walk you through a great tax strategy, but Edward Jones doesn't give tax advice.
Mm-hmm.
So in order to make sure that what you're doing is in alignment with what's going on. I'm going to send you to Samara. She also has information I don't, right?
Right.
That's important for the experts in their fields to understand and to serve their purposes. And in addition to that, our job behind the scenes is to make sure that we're able to pick up the phone and say, okay, and for those of you who have financial advisors, you might ask your financial advisors, are you doing this? When tax season rolls around, the three of us are sitting in the room, your
Right.
accountant, your financial advisor, and you on the phone together in the same room, making sure that we are compliant, that we're following what we need to, and that the strategies that I'm offering are something that the tax advisor can make sure is being implemented in the most legal manner.
Right.
So, yeah, to your point, and that sort of gets into milestone 2, both for professionals and business, because that's where I kind of want to start digging into the weeds when it comes to tax advantage strategies, right? Accounts that you might choose. Milestone 2, can I jump in, Samara? Is that all right?
Yeah, go ahead, jump in.
All right, so milestone 2 is gaining stability. So I'll talk about what that means for personal finances and for business.
Hmm.
Gaining stability, personal finances. Number one, you want to make sure that you are taking advantage of employer matches and employer retirement opportunities. This is free money that your employers are pretty much giving to you, right?
Yes.
Some of you might say, no, I deserve that money, right? But for those of you who are business owners but still working, those of you who are working, thinking of starting your own business, take the advantage while you can of employer
Hmm.
matches, right? That means that you put in a little bit to your retirement account that they hold, and they're putting in and matching whatever you put in, right? And that's different from business to business.
Right.
3% in one place might be 6% in another. Take advantage, right?
Hmm.
For those teachers out there, take advantage of the optional retirement accounts. Those 403b accounts, they
Right.
might be Roth, they might be pre-tax. Take advantage of saving your money in these sorts of vehicles. They're pre-tax, right? What that means, as you probably know, this audience, you're taking money right from your paycheck directly before you take taxes, which
Hmm.
reduces your taxable income. So
Hmm.
to utilize your position as a faculty member, as a teacher, as an employee, take advantage. Number two, this is something we don't often talk about, but it's a secret out there that I think everyone should look into is HSA accounts. Samara, I don't know if you've talked about this on the podcast
Hmm.
before, but HSA accounts are wonderful opportunities to save in a tax advantage manner. You have to meet certain requirements, and I would love to sit down with you all to go through that. For instance, you have to be enrolled in a qualified high deductible health plan.
Correct.
But HSA accounts are wonderful in that, number one, if you're using them to spend, which is not my recommendation, but possible, your
Hmm.
contributions are tax free and distributions are also tax free for qualified medical expenses. It's a
Hmm.
great way to not pay taxes on a dime that you used for those qualified medical expenses. If you use it in the way that we suggest, that's as a savings vehicle, right? So you only touch it when necessary and you allow it to grow. You find the type of HSAs where you can invest the money, and it's pretty much serving as a sort of retirement account, right? So when you get to retirement, when you start asking about long term care expenses or other health expenses in the future, you can pull from these funds in a tax advantage manner to contribute to that, right? So think about where an HSA account might fit into your strategy. HSA is not FSA. Understand the
Right.
difference. HSA money, right, is carried over into the next year.
Right.
Number 3 for personal would be diversifying your retirement strategy.
Mm.
So many clients that I get, they come to me and they say, yeah, I have retirement taken care of. Well, what does that mean? Well, I'm putting X amount, I'm putting 10 to 15%, which is a great percentage,
Hmm.
into my 401k. I don't need to think about anything else. Not exactly accurate, right? You want to diversify this strategy so that when you get to retirement, you're able to utilize accounts in different manners.
Right.
You have pre-tax money, 401ks, traditional
Right.
IRAs. And I use the analogy of planting a seed and then the fruit sprouting. Do you pay taxes on the seed or taxes on the fruit?
I
Well,
go.
in pre-tax money, you pay taxes
The
on the
fruit.
fruit
Right.
that has sprouted. And when you think about why this would be tax advantaged, well, many of us, when we get to retirement, aren't working anymore. That means our tax brackets are lower, right? And you are now paying lower taxes on that money in retirement than you would have now. So pre-tax money. That being said, you have other types of accounts like Roth IRAs
Hmm.
that's after tax money. If we use the same analogy, you plant a seed, you pay taxes on that seed, and then you allow the earnings to accumulate tax free, right? And this is also an important part of your tax strategy. It's not necessary for everyone, it depends on where you are in your
Mhm.
income, but it can be a great way to diversify your strategy, earn gain money tax free when you go to take it out and distribute. So just think about that. There are other types of accounts. In my strategy, we use brokerage accounts as a basic aspect of retirement strategy, strategizing. So just keep in mind there are many different routes that you can take. These are just two options. Yeah, go ahead, Smart.
No, I was go ahead. I'll chime in a little later.
I was going to go to milestone two, gaining stability for businesses. So go ahead, chime in.
Okay, so I love how you broke down the fruit and the
Mhm.
seed, because that is absolutely why Five Finance Family, you have to have a tailored strategy. So
Yes.
even revisiting the Roth, right? If you're at a certain income level, you can't even contribute to the Roth. Like it's not even something that you can access as a strategy. All right, so let's just put a pin in that. Okay,
Hold
so
on,
like,
hold on. Let's talk about that though. So
yeah,
this
let's
is what
talk
I
about
meant
that.
by all of these other types of strategies. Talk to a financial advisor. So
Backdoor
many people
Roth?
believe, right? Yeah. For Roth conversions, right? It
Right.
depends on what you have in place already. You could
That's
do
right.
backdoor Roths,
That's
which means if
right.
you're over that limit, I think 2023 was something like 144. The
Correct.
numbers change. Also, why you want to talk to your professionals, but
Exactly.
you're able to contribute in a backdoor sort of way if you're
Hmm.
over the contribution limits. The tailored strategy is still important because that might not be the right strategy for you.
Hmm.
It depends on what else you have. You also have, things like a life insurance retirement plan. We call them
Hmm.
LERPs for high earners who want to max out retirement savings in a tax advantage manner. There are all sorts of things out there. It
Right.
depends on what you're bringing to the table, right? So don't just write something off just because you think you can't do
Right.
it. There's a backdoor strategy to get it done.
Yeah, you're right. Because there is a backdoor Roth strategy that I have used successfully for a client. But again, you can't go at this alone. That's the point that we're trying to make is you cannot go at this alone because you may look and say, oh man, I made too much money. I don't qualify for this Roth. Next. But to Dr. Noni's point, you can definitely invest that in another retirement strategy, and then we go through the back door and convert it into a Roth. Now, when you do the conversion, there are some tax implications. All right, let's make sure we're clear. We're not talking about tax evasion, y'all. There are some tax implications, but you can definitely do it that way. So I appreciate you breaking that down and explaining that to us.
Of course.
So continue.
All right. So we're at milestone number two. I hope you're following. But if you're not, that's okay. Come talk to me. We can break it down for your personal sort of situation. Milestone two for businesses. We're at gaining stability. What does that look like? So maybe you're in the green, right? We finally made it to the point where you're making money, with your business. Now you want to start thinking about how you are using that money coming in to, of course, save on taxes. That's, the purpose of this podcast, but also grow your funds for different purposes. So one thing that we do at Edward Jones is help employers develop retirement plans either for themselves if they're self-employed and have contractors. I have a lot of businesses like this, right? Or if you're an employer who has employees, there are different retirement accounts. There are different options that we're able to set up for these different circumstances, right? For instance, you have simple IRAs, you have SEP retirement plans,
Yes.
or we have for those who are self-employed, we have certain accounts called owner Ks, very similar to the 401k model, which allows you to sort of start putting money aside for your retirement in the same way you might if you were working for another company. So
Right.
there are a lot of different options. Edward Jones also offers when you're putting together a retirement plan for your business and for employees, we offer the services of a third party administrator, which allows you to do everything in house, right? And to put together a plan that makes sense, that's tax compliant. We'll get in touch with, those like Samara who are able to figure out the tax end of things and sort of
Yes.
set this up for you all to get to your long term goals, right? Because we want you to have a multifaceted strategy when it comes to your business. You're not just dumping everything back into the business. unless that's your goal, you also want to start thinking about retirement savings. So gaining stability is just sort of doing the homework, talking to those you need to on the various options for how to save money in these retirement plans, keep money from being taxed in a certain way, using retirement accounts for these purposes as you work toward your long-term goals.
That's really, really good. And I love how you broke that down, especially for my business owners, because
Mhm.
I tell people this all the time. There are certain retirement plans that you can have as a business owner, but once you involve employees, certain retirement, right, you have to choose certain other strategies. And you said owner, but I know it as a solo
So
401k. Is that the same one?
yeah,
Okay, okay. All right.
yeah.
I just want to make sure we were talking about the right thing because I have had a show comparing the solo 401k to the SEP IRA and what are the qualifications and the advantages and disadvantages and stuff. So, okay, good. So glad we're
Yeah.
on that page. I'm sorry, didn't mean to
No, no,
interrupt.
no. This is good. This is good because this it demonstrates how, the partnership that you want on your
Right,
team. Samara handles certain aspects, your advisor handles other aspects in pushing you towards the right places. Both of us want to make sure that you're meeting your goals. Both of us understand the importance of analyzing what those goals look
right,
like so that we can, point out areas, dark areas that you might not see, etc.
right.
So that's sort of part of our
Yeah.
job.
And I'm really big on the compliance aspect, right? So I'm like, listen, we
Paramount.
right, we could do all the strategies in the world. We just need to make sure that we're being compliant according to the IRC, right? The revenue code. So we need to that's why you have to work with individuals. Multiple people need to be at this table. One, to make sure you achieve the goals you want to achieve, but then also to make sure that we're doing that in compliance because us putting certain tax strategies in place that will make you out of compliance can actually cost you more down the road, right? And penalties and fees. And that's not what we want to do. We don't want to undo all the hard work we did. So definitely that is important. I'm glad that you took some time to walk us through what that
Yeah.
looks like for an individual and for a business. I appreciate that. So
Absolutely.
are you finished? I'm sorry, I didn't want to interrupt.
Well, there is one more milestone. Do we have the time for it?
Yes, we have
Okay, good.
time.
It piggybacks on what you're saying, but also adds another element, right? When we're putting, this goes back to what I said at the beginning. When we're doing comprehensive strategies,
Hmm.
that means that we understand that everyone to some degree has a complex sort of situation. What I mean by that is that you're going to have certain accounts that function in a certain way and other accounts that function in a different way. So our job is to make sure that we have a strategy that's integrating your different goals, where certain goals might be attached to certain types of accounts and strategies and other goals might be attached to others. So let me dive in. Milestone number 3, this is the last piece. I'll start with your personal finances. Milestone 3 is called optimizing your finances. You
Mm,
finally got to a place where you've gained stability, you have that foundation. Now we're working on what it looks like to optimize, right? Number 1 in your optimization personal finances strategy is automating your savings. You want to get to the place where you are not thinking about pinching off your savings every single month and putting it in the different sorts of accounts. You want to automate your retirement and non-retirement savings so that you have peace of mind and that your saving strategy is sort of working for you without you thinking about it, right? Number 2, we talked about the importance of working with an advisor, an accountant, an attorney, right? And that's, well, I know that's for the businesses, but also for personal finances, getting clear about your goals and integrating them in a nice way into an overall strategy where different accounts, as I just mentioned, serve different purposes, right? Meaning that they're invested in different ways. So I gave the example of someone bringing to me $30,000 or $100,000 to invest. And they might say to me, I just want this money to grow for me. I'm aggressive. I'm 30 years from retirement. Just let it grow. Well, if you bring me $100,000 for retirement and you're 30 years
mm,
out, sure, that's how we'll invest. But if you bring me $100,000, and I'm sort of getting into the business side of things, if you bring me $100,000 for your business and you tell me that in 3 to 5 years, you want to use these funds to purchase more a property, right? Or
mm,
land so that you can build out. We are not investing this money in the same way that we're investing your retirement
mm.
funds. So to be able to work with an individual that can consolidate, right, or a team that can consolidate your goals and consolidate the accounts to understand the different ways you're investing in different accounts is very, very, very important here, right? Because when you get to that 3 to 5 years and you need the cash, you don't want that tied up into the market. You want to have a strategy that's moving you closer towards income. So just keep that in mind. That overall strategy is important here. And then the last piece in optimizing your finances is really getting into the weeds with planning your legacy, planning your estate. And that's where we come into conversation around 529 plans or even small little fun, goals like setting aside money for travel, right? And being able to segregate that from your day-to-day expenses, right? Maximizing and automating savings to various different goals. And again, I don't have the time here to outline the many different strategies we have for the different types of legacy planning. But this is where we start to think about this and have conversations with you. What do you want to do with your money? Are we putting it in a trust for when you pass away to be distributed to your favorite charities? There's a
Right.
way to do that, right? And so this is the piece for personal. And then for financial, for the milestone number 3 for businesses, I won't get into this in detail, but this is where I think about succession planning and where we have strategies where we really break down how is it that you want to start to think about transitioning the business, right? Again, that goes back to the cash cow question. What is it? What are your goals, right? So this is where we sort of get into and discuss succession planning.
I love it. And we had an estate attorney. Hold on one moment.
Mhm. I don't know how long this moment is. I kind of want
No, no
to jump.
worries.
Okay.
Okay. So I'm sorry about that. So you may not be able to see me on screen, but you can hear me. Yes. Okay. So
Mhm.
we had an estate attorney that was on, and she was talking about putting your business right into a trust, if you will, or protecting it in a way so it can be distributed to the beneficiary. So I'm glad that you talked about succession planning, and thank you so much for like walking us through those different aspects, the three main points for businesses and personal. Like, I know that it was truly helpful.
Mhm.
So I don't want to end this conversation because it's so good, but I do want to be mindful of everybody's time. So I would love for you to tell how to connect with you.
Absolutely. And can I take 1 minute to just talk about investing? Is that okay? Do we not?
Absolutely.
Okay, because
Absolutely.
I know that you all were itching for investment advice, and I sort of did the work around here. But I know that a lot of you are thinking about what it means to invest and diversify, your investment. So if you're just talking about putting money in an account, make sure that you're thinking about a diversified strategy. And diversification, is a word that applies to various different aspects of this process. So you want to sit down and think about your time horizon, your risk tolerance, your portfolio objective. Are you saving strictly in income or investing in income producing investments? Those are stocks. I'm sorry. Delete that. Those are bonds and CDs, not stocks. So when we say income producing, we're thinking of bonds and CDs, the safer investments. When we think of growth, right, capital appreciation, that's where stocks and equity come into play. You want a mix of both. And that depends on where you are, based on your time horizon, and based on your risk tolerance. There's also a diversity of asset classes. You might invest in large cap stocks versus small cap stocks. And then there's a diversity of investment sectors, right? If you're investing in individual stock, that might be technology versus consumer staples versus energy. So I know I'm throwing a lot at you at the end, but I just want you to understand. And when if we work together, we can sort of break down what this looks like. When you go into the market, depending on your strategy, depending on your goals, you want to make sure you have a diversified strategy. And I'll end there. So I know you want to talk about how people can get in touch with me, how clients.
Absolutely. Yes. Please share with them how they can get into contact with you.
Absolutely. So I saw on the screen, there we go, my Edward Jones website. So if you find me, you can easily request a consultation for this group here. I am offering, in partnership with Samara, I am offering free one on one consultations. We can talk about personal finances, your business finances, sort of just break down your overall goals. But I'm doing free one on one consultations for any of those in the audience who would like to sit down and think about a strategy. You can reach out to me on this site. Where you just fill out this form that you see here. You can also get in touch with me at my email. My Edward Jones email is Denise, Denise. It's my middle name, Denise.Carter at edwardjones.com.
Awesome sauce. And you all make sure that you reach out to Dr. Noni because a lot of the information that was shared is just the tip, y'all, of the iceberg. I promise you, it's so much complexity in tax planning and in investment planning. That's why I always tell my clients it's not a one size fit all type approach when you're planning, when you're implementing these strategies. And that's why I also have clients connect with me on a one-on-one basis, right? Because what works for you may not work for Joe and vice versa. And so, Dr. Noni, I'm glad that you take that same approach. And it sounds like you approach it with care as well, like, just educating along the way, because we love to do that at Five Finance. Like, we educate our clients along the way. Because y'all, again, it's a team effort, right? And we want you to definitely understand what we're implementing, why we're implementing it, and then giving you the tools to do so. So again, Dr. Noni, thank you so much. This has been an amazing conversation. I feel like there's a part two. Like I feel like there needs to be a part two.
Yeah, we can go deeper into the weeds.
Yes, let's get into it. Yes, I feel like it's a part two. But
Yes,
I will ask you
thank
to
you for
please
having
wait
me.
backstage while I
Okay.
wrap everything up. But everybody, please say goodbye to Dr. Noni again. Thank you so much for joining us tonight.
Yes, absolutely. Thank you, Samara.
All right, I'll see you soon. So for finance family, I know that this was a little longer, but the content was so good. I didn't want to stop her. I wanted to make sure that you got what you came for, and I feel like you got more than what you came for, right? I so appreciate Dr. Noni gracing us with all of her knowledge and expertise and walking us through investment planning 101. So I know you took a lot of notes. I know you were engaging in the comments. We greatly appreciate that. If we didn't get to answer all of your questions in the comments, don't worry. They will be answered, okay? Even if it's after the show is aired. So make sure you go back and check. More importantly, make sure you are liking, subscribing, and sharing the Tax Takeover. Like I said, every week we bring before you this amazing content. We want you to be educated, and we definitely want you to share this information with others, right? Also, don't forget to follow me on LinkedIn. I'm also in these LinkedIn streets. So make sure you follow us there so that you can get some more good, engaging content. I produce newsletters that we send out as well on LinkedIn. So you can subscribe to our newsletter while you are there as well. Okay. And then last but not least, if you want to connect with me on a one-on-one basis, make sure you are visiting my website, fivefinance.com, and you can go /booking to the booking page, and you can connect with me personally so we can create a tailored tax planning strategy for you. All right. Again, you can tax plan no matter where you are on your financial journey, just like you can investment plan no matter where you are on your financial journey. All right. So hopefully this information was amazing for you. Hopefully you were able to digest it. I would recommend that you go back and rewatch because it was a lot of content and I want to make sure that you get it all. And I would also suggest sharing this content. All right. We're so grateful that Dr. Noni graced us with her time and presence and gave us all of this amazing information for free, y'all. Okay. And you heard about the gift that she is graciously giving to all of the Five Finance audience. Make sure you take advantage of that as well. And we'll have her link in the description. All right. So, again, thank you so much for joining us for another episode of the Tax Takeover. Please make sure that you are ready for next week because we're going to have another guest on and we're going to be talking about another interesting topic. So please make sure that you stay tuned and make sure you like and subscribe. Hit that notification bell so that you never miss an episode. So until next time, Bye Finance family, happy tax planning.